Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Can everyone see my screen and hear me? Somebody could just type in a little Y or yes. We can go ahead and get started. All right, thank you very much. Let's go. All right, so we are looking for a top of a B wave in the broad market, most likely. There are still some chances of some sort of convoluted pattern that attempts to try and get higher, but I really don't think that that's reliable. We were looking for an A, B, C move up with the B wave holding the December low and swinging up towards at least a minimum of the 4260 region, which we fell short of. Initially, when it looked like we were going to get an impulse, it had some potential to get closer to the 4400s. But then the way that we failed to hold a small micro support at the very beginning of February took us out of an impulsive pattern and then looking for a larger fourth as the fourth wave of a diagonal. We have now faded too deep for that to be reliable in the S&P. It's still valid, but it's very, very unreliable. So that leaves us with a couple of considerations. One, either we had some sort of truncated or muted top, or maybe a WXY that completed at the top that we saw in February, or maybe that truncated top on February 14th was all of the C wave of that B as a truncated move. So this is zoomed in, looking off the October low. The other potential, so that's potential one, is that however incomplete it looks, this nominal higher high or maybe a truncated top here was all of the B wave that we get. So that's one. The other potential is that some alternate pattern played out that actually bottomed back here in June, and the October low was really the B wave, and then we did complete some sort of 5 waves up as a diagonal for the C wave in this wider expanded flat. I've shown this count before with regard to XLF. That I thought, I mentioned when we were topping in February that I thought there was some pretty significant risk that the XLF could count this way. And that if I was going to see any weakness, then that might be one of the areas that we look for it from. The other alternative, though, is that we have some sort of more complicated pattern that is still going to try and get at least one more high in this B wave. Now, as I said, this fourth wave technically is still valid, but we're already dipping under 78.6% Fibonacci retrace of this third. And we could even move the wave 1 back here or count, the 1-2 a little bit differently, which might make a little bit more sense now, but it still is pretty deep in a much larger consolidation relative to anything that we would count as the wave 2. So as a fourth, it is really unreliable. One of the other alternatives is that this is the A wave, and that this is A and B, and we're working on the C wave of an expanded running flat, which would allow for a new attempt at the C wave up of our parentheses B wave. So instead of that being off of the December low, it would be a measured move off of wherever we bottom, but that still allows for more of a third, a fourth, and a fifth of that C wave that can easily head down closer to the 3800 region. So that's another possibility that we need to consider, although that seems a little bit more bullish than most of the context that I see from other sectors and charts allows. The other thing that I do have on my chart here that I wanted to talk about briefly, and then we'll look and see where we can see possible support for that in other charts, is that instead of this being an A, B, C wave move up for our parentheses B wave, we know that C waves have to be 5 waves. But if we're not getting the clear 5-wave move for a C wave, then that's when we start to consider something like a complex combination pattern, also called a WXY pattern, where instead of an A, B, and a 5-wave C wave, you have a WX and then the Y wave that can be an ABC. So there is a risk that this was all of that Y wave. That was one of the possibilities that we talked about there. But since we do have what looks mostly corrective still, even if it's much, much deeper than as reliable as a fourth, I think that is something that is worthwhile to consider, especially if we get a new 5-wave up move that can hold a 3-wave retrace to a higher low and sets up for a potential to try and swing back up again towards that cluster of fibs at the 4260 region. We're going to switch gears in a minute to look at some of the charts that might be a little bit more supportive of a move like that. But I want to go back to this larger degree chart and just reiterate that however we might still try to get higher in this B wave, I think the more important thing to consider, the more prudent thing to consider, is that there is risk that we don't get higher in the B wave, and that instead we're trying to stealthily start this C wave down. So the risk skew is very much to the downside, and Garrett and I are continuing to see more and more charts that are looking more like a significant top was struck, not just back here at the end of 2021 or beginning of 2022, but more recently that plenty of things that can easily count as an ABC up complete, or that ideally would have gotten one more high, but have now gotten too deep to be valid as a fourth wave, similar to the S&P. So with that in mind, that the bigger risk skew is down, and you need to be making position moves in your portfolio to protect yourself from that bigger risk. And any attempts to trade for those moves higher are traded with much smaller risk capital and in a much more conservative way with tighter stops and as scalps. But that however you're looking to stay safe during the, a 25 to 30% decline projected for that intermediate degree C wave, which could certainly extend beyond that, that you're already having a lot of those in place, or at least really starting to make those adjustments now with the fact that this is failing to hold a lot of reliable support. So with that in mind, I wanted to switch gears and take a quick look at the equal weight. I'm going to refresh that because I don't think it actually dropped there. The equal weight NASDAQ, which is holding much better as far as our fourth wave. Not only is it holding much better as far as our fourth wave in general, but it is still holding a nominally higher low from the low that was struck last week on February 24th. So that is one area where we have a more reliable potential to just get that fourth wave to one more high into this 103 to 105 region before we put in that major top. So certainly failing to hold the 94.75 level and breaking down further under the 94s would put that in jeopardy. But from right here, this is one of the charts that does still have a good possibility to do that. And it carries over when we look at the NASDAQ itself. The same potential is there. Going to zoom out just a little bit and get rid of all of these fibs tools, local fib tools, so you can see the structure. So still holding that 618 retrace as the fourth wave. I put the faded yellow B wave there because this did get all the way up to a 1236 extension, whereas the S&P barely got to a 0.618 extension. So in terms of the fibs reached for the C wave, we did hit normal fibs in the NASDAQ itself. But like the equal weight NASDAQ, we are still trying to hold that 11,900s as the fourth and allow for the ABC move up for one more high towards the 13,200 region. So that would be ideal. And I'm going to share with you guys some of the charts that, again, the tech sector really looks like a stronger driver of that potential. This is the XLK ETF that still looks very, very strongly like it is holding a fourth wave, allowing for one more high to that 146 to 149 region, which is the ideal top for the C wave of B. And then also driving that, I think, is the semiconductors, which we look at a lot in stock waves. And I did share some stuff on that in the main room this morning. Just that we really need to hold. We have a couple of higher lows off of the low from February, actually 22nd. Was the low that was struck in semiconductors. It led off of the low and didn't make a lower low on the 24th, like the NASDAQ itself did, or QQEW at least. So again, holding is that 618 retrace. So not only is it holding a higher relative low to the S&P that's more reliable as a fourth wave to get one more high in the C of B, but it also is holding higher lows off of that. But if that 236.30 region fails, that would be, or we'll just say 236, that would be a big, big warning that, this low is going to break, and then that could be possibly 5 waves down from this high, which even though ideally this is a fourth and we get a 5th wave up, we did get pretty close to a 100% extension and pretty close to a 618 retrace. So this could be all of our C of B wave, and we would just count a smaller 1, 2, and then stretch the 3 up to here, and then a 4 and a 5 for all of that move. That's not the ideal way of counting. The ideal, and what we look at on a lot of the individual names, is that this should still be a fourth and try for one more high. So if I were going to be trading for that one more high, again, keeping in mind the broader risk that a larger C wave down is due to start. And so you're talking about a potential for an additional roughly 14% to the upside and a potential for 50% to the downside for a normal measured move C wave that we're looking for on SMH in stock waves. That's the semiconductor index. So, certainly better chance at one more high here, but keep that risk skew in mind and use that in terms of the way that you manage. And, maybe that's where you also start building some initial speculative put positions for longer term move to the downside, and then look to add to it on a higher high, and then just scalp, the move higher to try and pay for that, or as a hedge for building that longer term put position. It's just a possible approach. All right, so also wanted to take a look at the Russell. The Russell is also a surprising area of strength that is arguing for this being a fourth wave. It's a little bit different. I think we've discussed this before in when you've been with me for the Beginner Circle webinars, whereas S&P and the NASDAQ count the parentheses A wave at a lower low here in October and an A, B, and a C wave up off of there that ideally gets one more high in the NASDAQ, with this being the same fourth. The Russell did not make a lower low and looks more like this is an A, and this is an ABC move down for a B wave to a nominally higher low in October, and then an ending diagonal for that's actually a 5 wave, 5, 3, 5, 3, hopefully 5 waves up as a little bit rarer form of ending diagonal for that C wave. But again, at the end of the day, it's holding the same degree fourth of the C wave of the same parentheses B, ideally heading up to the 230s, the 2037, maybe into the 2070s, and possibly stretching closer to 2100, which is the 618. But it really only needs a nominal higher high over the 3, and the 100% extension for our C wave is at 2037. So that could easily do it. But another area, and again, the small caps is not always the most cohesive of an index because it is a very, very, very broad equal weight of some things that are often very, very different counts on an individual basis. But similar to the semiconductors, it's holding much more reliable support as this fourth. And not only is it holding reliable support, but it's holding off of that February 24th low. So again, another better risk reward area to look for that structure. Speaking of blue chips, we can look at the Dow. So counting the larger, wider flat works better in the Dow, I think, than the S&P. And this is something that we had also warned about in stock waves. There are a lot of things that we were seeing that looked only like a three-wave move up into this February high. And I posted this in the EWT room in the market section that there was this risk of a wider flat playing out. So we are getting a C wave down. We can still get more of a fourth and a fifth of that C wave, but it doesn't need that much lower. You could squeeze in enough subwaves, and there is some confluence of Fibonacci support here with the 764 extension of the C wave. With possibly being able to count 5 waves down there and a 382, but leaving room to head lower to the 32,000 region, I think is certainly prudent. If it gets much over 33,300, then that might be the first indication that it's trying to start the C wave. And again, this is another one of the things that we had looked at. A lot of the names that Garrett and I posted in stock waves back in November that had a better chance of making new all-time highs have a similar structure of a larger A and a B wave and a fifth. That doesn't mean they're the better plays on a percentage basis, but they do still have a chance of reaching a new higher high over the highs that were hit back here in early 2022 with the top in most of the other index charts. All right, let's shift gears a little bit now, unless there are other questions on those indexes. I do want to go to the equal weight. I think the equal weight also, even more so than the S&P, came way too deep to reliably be a fourth. So there, I have the red count that we borrowed from XLF as a risk, but again, so far we only have 3 waves down off of that high. So the potential there, the same WX and a Y wave, with that being an A, B, and a C wave up for the Y, trying to target that 159 to 160 region if it can hold in this 146 to 143 support zone. So, the more we struggle to get anything going off of this, the more concerning it is that we have possibly topped. Let's take a quick look at XLF. XLF, as deep as this is, I don't think it looks good as that as I mean, I guess we could say the same purple A, B, and a possible C wave for a Y. But again, that same potential red count, I think, is looming and pretty scary here, especially if this loses the 3520s, then it can start to look like 5 waves down forming off of this high. So one more high up would certainly be ideal, whether that is a C wave of 3 and then a fourth and a fifth, or just that same purple Y wave trying to complete into the 3840s, but certainly some risk there. We can look at the transports. The transports even more so definitely did not hold as a fourth. So let's get rid of some of this. So there's a significant risk that they just topped at a 764 extension of the C wave as 1, 2, 3, 4, 5 waves up for the C, and just past the 618 fib. So only 3 waves down so far. I think it's worthwhile to consider the same potential where this is an A, this is a B wave, and you get maybe a muted C of a Y wave, if they're not going to be breaking down here. Now, just because we only have 3 waves down does not mean that this can't be working on the start of the C wave. The C wave could start as initially getting a 3-wave move. Where's my C? Oh, it's way over there. To zoom out to a daily chart to find my C wave. There we go. Let's move that in a little bit closer. Not because I think that the entire move is going to be complete by January. I think it could certainly end up taking longer. But I would like to be able to show everything on one screen. And this more or less matches the slope of this initial move down. So it is possible that we're working on a leading diagonal. So 21440 is the 382, which is normally where we want to see wave 1 of a C wave fall. The structure that we have so far off of the high is clearly corrective as an ABC move down, but that could be the A wave that could either be wave 1 of a leading diagonal, which would probably project a lot lower. So this might try and bounce more as a wave 2. So I'd either call this either the A of wave 1 or the wave 1 of wave 1. So either it's working on wave 1, and we'll give it the benefit of the doubt that it is working on a larger leading diagonal. And so we'll move that down closer to the 200 region over here. Get rid of those for now. So if it's a leading diagonal, this is what that would look like. I would count this as just, oops, it's not moving. This is just wave 1. It's working on wave 2, and then would need an ABC move down for the 3rd, and then a pretty big bounce for a 4th, and then an ABC move down for the 5th wave. So if this is starting, I think we're kind of limited to a diagonal, or this could be A, B, and then it gets a C wave down to wave 1 here, and that would be of an ending diagonal for the entire C wave. And we'll add that with a little note as wave 1 here in blue. So I think as long as we're going to hold, I'd probably say holding on to the 228 region, then there's a good chance that it at least tries for higher as a wave 2 bounce. So it can fade a little bit more, but then try and bounce up to the 238, 239 region in transports. And then could be bearish from there. But there's an equal chance that if it's going to get up closer to the 238, 239 region, that it tries to extend higher in our alt purple ABC of a Y wave, which is a very complex, less reliable pattern. Certainly not something that you call in advance and rely heavily on it. Certainly not when the B wave can easily count as complete. But again, this is one of the types of charts where you can start building a longer term bearish position and then hedging that for some short-term upside potential. All right, now let's really change gears. Let's first look at bonds. Starting with our 30-year Treasury, which is trying to hold a 618 fib retrace after what looks like 5 waves up and then an ABC retrace. We had a potential move up that we were counting as an A wave and a retrace to a 50% retrace as a B. And what looked good at the time as 5 waves up as wave 1, but we couldn't hold our ideal retrace support in this 128 region and instead leaked lower and now look like we have a larger 5 up wave A and a B wave, which we had talked about in the 10-year. So what we want to see is based on Fibonacci pinball, and we can apply the same Fibonacci pinball that we use for a third wave to a C wave. Just we use a little bit different fibs. So let's move this up to the front. So ideally, we want to still see the same 382 or maybe a 50 hit, and these are the green fibs for our circle wave C. So that would be wave 1, and that's in 1, 2, 3, 4, 5, and that'll get us up closer to the 1236 or maybe even the 138.2% fib. If we only get 5 waves up to the 129 region, then we'll probably lower this target down to the 764, and then this target down to just the 139, 140 region for that C of A. But this would be a little bit more ideal. So far, we have not made any new lows yet, but we did not get as big of a move that I would like to see for that to reliably be that wave 1. So let's just move this down now. And if we get more, we can always increase the expectations again, but this looks a little bit more believable. So that's what we'd like to see on the 30-year. Let's move over to the 10-year Treasury. And again, still trying to hold this B wave at a deeper fib at the 764. Would like to see it continue to get more of a wave 1 off of that low. And the ideal target for wave 1 here is going to be this 113 region. And now we can, with both of those in mind, we can pull up our TLT chart. I have to go to our micro counts tab. And we can see the same structure and the same potential, where we're making nominal new lows here, still as the 5th wave of the B. But even though it's nominally lower, we're actually still holding closer to the 50% fib as opposed to the 30-year, which came down to the 618. But the actual treasuries themselves are both holding a move off of lows that were struck last week, whereas TLT's heading a little bit nominally lower still. We'll lower this closer to that 382 fib. And still looking for 5 waves up to form for that parentheses wave 1, which ideally is going to target at least the 107 region, possibly all the way up to 109.40. So that's our bonds. I really like this setup in bonds. One, it just looks like a great setup. You know, while I'm counting this as an A and a B, we have what looks like 5 waves up, holding into a 3-wave retrace in our ideal fib zone. So this is something that you should look at as a tradable setup on any instrument. But I particularly like bonds here because of the potential for us to be topping in the larger B wave in the market, and that it's possible that bonds become a safety trade again and a haven for cash that people might be pulling out of the market once we do actually top, and then starting to accelerate that, putting money into the treasuries, particularly the 10-year and the 30-year, as they continue to draw more money out of the market. And I think that has the potential of kind of fitting with the bigger C wave down that we see in the market with the C wave up in treasuries. In terms of other safety trades, I think that's a good time to shift gears and take a look at our gold chart. I think that gold counts best as an ABC up for wave 1 in this larger ending diagonal. That's why I have this colored in blue. I faded out my wave 1 that was looking for a possible 4th here and one more high, because I think we faded too deep to be the 4th wave of a leading diagonal reliably, and that would kind of be too big. So this GDX being in wave 2 and a lot of other things being in wave 2, I think makes a lot more sense. Because I think this is an ending diagonal, is ABC up for wave 1, I think it makes a lot more sense for gold to get a wider flat for its wave 2. So I want this to just be a B wave bounce, but the B wave bounce can easily get us closer to the 1925 to 1950 region, and it's possible that that starts to turn into more than just a B wave. So off of the recent low, I do think there is very good risk reward, particularly if we get a little bit more of this smaller degree consolidation, that there is good risk reward to continue to play for more of a B wave bounce. Because again, it's possible that it gets more than just a B wave bounce, that it gets this alt fifth wave up as an A, B, C move up for a slightly larger wave 1. And possible that this is actually all of the wave 2, even though it's on the shallow side and not very wide for it being a diagonal. So decent move up that also could be 5 waves up off of the low in gold. I would love to see a retrace back down to about 1830 to 1825 would be that ideal fib zone, and that can swing up towards the 1870s, then should get another retrace from there, holding 1840 region, and then on up to that 1910, maybe all the way up to 1950 for the normal targets for a B wave. Contrasting that with silver, silver could be getting the 5th wave of that leading diagonal for wave 1 as well, or like gold, even though it made lows prior to gold's low, could be in the same wave 2, possibly filling out as a much wider flat, but a greater chance, because this came all the way down close to a 618 retrace. That's not actually the 618 retrace for the wave 2. This is the 618 retrace, so we're only a little bit under the 50. That's as a fourth. But we are close to a more reliable fib level that could be all of this wave 2 for silver. So, and again, because we came closer to the 50% fib, even if this is just the A wave, the relative move in the B wave should also be higher, even if it's just going to get a wider flat. So from a relative value standpoint, I think silver is I mean, it's certainly a more volatile trade. I think the clarity in gold is a little bit better, but bang for your buck, you're probably liable to get a little bit more out of the silver move. I did want to take a look at the gold to silver ratio chart with you guys, because I haven't done that in a while. So looking for the gold to silver ratio chart should be pretty close to a temporary top. I don't know if I would consider this 5 waves down as a leading diagonal. I think that is probably an ABC move down for either the A wave, probably just the A wave of a bigger wave 1, of an ending diagonal down for the C, but it could be all of wave 1. We'll go ahead and call that all of 1 and 2. And then put our alt wave 1 here. We'll tell that to ignore that issue. So I'm going to look for an ABC move down for this third, because I think that this is a diagonal. But there is a chance that this drop here is an alt of a larger wave 1 in the same diagonal. But good setup here for silver to outperform gold. So this is gold and silver ratio chart, or gold divided by silver. So as this falls, then the relative value of silver is usually greater, or just the relative performance is stronger. All right, so that is the metals. Let's go to GDX. GDX, as we said, looks much better as 5 waves up off of the September low. We have a retrace to a 50% retrace, but it's pretty sharp. So usually when we have a sharper ABC move down, our default expectation is that is only an A wave, and we're going to get a high B wave and then a C wave down as a wider flat, maybe to our ideal 618 fib, which is at 2542 on GDX. But we do have 5 waves up and an ABC retrace that got to a 50%. So there is a decent chance that that was all of the wave 2, and that instead of a B wave bounce as an A, B, C move up into this 3160 region, 3060 to 3160, we get 5 waves up as wave 1 of 3. There is still a slight chance that this could be a 4th, and that a move up to nominally higher in the 34 region could be an alt 5th wave of this wave 1, and then it would replay the ABC retrace as wave 2. But we would be looking for consolidation either way from this move. While there's a chance that that's starting the 3rd, and it might not get much of a retrace before breaking out again, it should at least get some consolidation. So you can at least trim some profits or hedge a little bit. Look for at least that to be an initial small corrective consolidation. And then as long as that's small and corrective, then maybe you can start to add back in with your risk reward set at this low. And if it starts a little bit more aggressively, then have to be on the lookout for that being a new ABC for an alt wave 2 from an alt higher high as 1, 2, 3, 4, 5 waves up here for that wave 1. And looking at this at the larger degree, nope, not that one. This, nope, not that one. This, there we go. The larger degree move, we're looking at this as the wave 1 and wave 2 of a C wave up inside the primary wave 3 of a larger diagonal. And, oops. So ideally, we are going to head up towards the 50s for our 3rd. And that is going to be, our ideal fib targets in that same 50s region, whether this is all of wave 2 and we're getting wave 1 of 3 now, or whether we're just going to get a B wave and a C wave of a wider flat. The individual names that Garrett and I track in the metals, miners, and agriculture service, a lot of those individual miners are on the fence. Stuff like Newmont looks much more like this needs to be all of its wave 2. It doesn't have as much room to get a B wave and a C of a wider flat, certainly not much of a deeper flat. And some other things have already come much lower, whereas things like the TXGM, which is more of an equal weight index of mining stocks that includes a lot more of the Canadian names, is only barely at the 3A2. So it looks a lot more like it's just the A wave and going to get a B wave and a C wave to be a more reliable wave 2. So we're going to be following those setups as we go. All right, let's shift gears now and go to energy. We'll start with looking at an oil chart. Haven't moved. Oh, you know what? I have this with more detail. Same count, but has been updated more recently. So the purple alt here, I think we talked about that before, is just to fit this a little bit closer to what we're seeing on on XLE and XOP and a lot of the individual names, where the ABC move here, instead of being an intermediate ABC off of a significant top, is an ABC at the minor degree for an intermediate wave 4, parentheses wave 4. So that's what fits more with XLE. The detail here is on the white count at a larger degree, and I just have those little notes. It should be the exact same subwave count, just 1 degree smaller. So instead of this being a parentheses B, it could be the purple minor degree B. Instead of this being a minor wave 1, it would be a circle, lowercase Roman numeral 1, and then you have the same 2. Instead of a minor 2, it's the purple 2, and instead of this 3, it's the purple 3. Could add a purple 4 here, but it just clutters the chart, so I just have that as a little note there. Right now, we are trying to hold the resistance in the 77, 78 region as a 1-2, 1-2 start to the third of that C wave down. So if that is going to start to fail here and break under the 74s, then it can drop down towards 66 in a hurry. So into the resistance zone, we can get rid of these fibs. Get rid of that. We can add a fib here for this wave 2. We are right at the 618 right now. Could be trying to get a little bit higher as an A, B, and 1, 2, 3, 4, 5 waves up as a C wave. So much past 79, and it's more likely that it's going to break over 80, 81, and that would at the very least probably be forcing a wider alt flat for this wave 2, the same wave 2 here. So if we're going to remain bearish, we really want to see this turn down hard from this 78, 79 region here. Then looking at natural gas. Oh, look at that, it moved right over. Natural gas is much further ahead in a similar C wave down to oil. I think it is certainly at least bouncing in the fourth wave. There is a chance that this was all of the C wave. It got pretty close to a 200% fib extension, but none of the consolidations inside here are large enough to be reliable as a minor degree fourth wave. So my preference is that this is the minor degree fourth wave right now. It's trying to head up at least to the 320s, possibly the 370s, much over the 370 region, and it's probably more than a fourth. I would like to see a fade to add to any scalps higher. If we can get a nice ABC fade down to the 230 region, then that sets up another nice swing move from there right to the 320s. Somebody asked if there's an SPX and gold are correlated. We don't talk about correlated in terms of direct moves, but I do price the S&P in gold terms. So I keep a ratio chart of this. Got a much sharper move than an ideal as an ABC here, but I think we can count. This is the A, this is the B, and then a stretched out fifth of the C for this bounce. So inside a move to the downside, if this was an extension of the primary wave 1 instead of being the parentheses B wave, then we still have a 3-wave start to the purple C wave. And so this can still be wave 1 and wave 2 of an ending diagonal for that purple C wave targeting this region. If this is an A and a B, then we should see 5 waves down here. So again, so this can be either A, B, C, and then a fourth, and then a fifth if it's the purple, or we should just see 5 waves down if we are starting the C wave of wave 3. But that does allow for a shift in relative values to continue between the S&P and gold. All right, what else? We can look at the dollar. I think this was all of a much smaller B wave here, and similar to the market, getting at least one more high as 1, 2, 3, 4, and a 5th wave up in the C wave to the 105.80 region would be more ideal. But I would not rely heavily on that. It's certainly possible that this was a WXY complete, or maybe this is an Alt A wave and it's going to fade deeper first and then head up to 107. I don't think there's a good, reliable trade for immediately higher in the dollar, and it is getting pretty treacherous here. What else do we normally cover in these groups that I'm missing? I think we hit everything, right? I'm not sure I understand your question, George, about presidential terms back. That might be a fractal thing. I don't follow the presidential cycles very well. When people mention it and it seems to fit with some LA wave structure, great. I look for other LA wave fractals and clues at larger degrees. All right, I think we'll go ahead and end there, and I'll get this uploaded for you guys, and I will see you next time. Have a great evening.